Hello, everyone. Welcome to another Altos Trading Live Strategy session with Jeff Tompkins. This is Richard Van Rich here with Craig Ward in the chat. We're really excited to have you guys with us tonight. Got a lot of great information to go over. If this is your first time on, you'll notice that your microphone's muted. That's so that we can all hear Jeff and I talk. But if you have any questions throughout the evening, you'll find at the bottom of your screen a Q&A box. And you click on that, put any questions there, and we'll get to those throughout the evening and at the end. Now, if you have any questions about your any trade alert service that you have with us, anything personal account related or access to any of our software, anything like that, email support@altostrading.com and we'll get back to you tomorrow with all that good stuff. If you have to hop off for any reason, don't worry. This is recorded and will be available in the members area later tonight and tomorrow on YouTube. So before I bring on Jeff, let me just read a disclaimer. Trading securities and options involves risks. Prior to buying and selling an option, investor must receive copy of characteristics and the risks of standardized options. Investors need a broker to trade securities, and options must meet suitability requirements. Past results are not necessarily indicative of future performance, and performance figures are based on actual trades, including real money results. Due to time-critical nature of trading, broker fees, and activity of other subscribers, there's no guarantee that subscribers will mirror our performance, and performance numbers shown are based on trades users could enter based on the trade signals. All right. With that being said, Jeff, if you're there, go ahead and grab the mic. How's it going?
Hey, good.
So are you jet lagged or what?
Yeah, back from another trip, Vegas trip.
That's right.
Yeah, I'm alive. March Madness.
It was a lot of fun. Was it crowded out there?
Yeah, it was crazy. It was like a pre-COVID crowd.
Oh, really?
Oh man. Yeah, it was back like the old days. So
that's good.
Traffic was bad.
Was it?
Oh God. Took you like 30 minutes to make it from one end of the strip to the other. It was that bad.
Were all the restaurants closed up like in Bally's like last time?
Yeah, they reopened some of them. So it's getting better. It's getting better.
Oh, that's good.
Yeah. So, all right. Well, welcome everybody. And looks like we got a good group on tonight. So we're going to start with our market overview. Obviously been a big rebound in the markets. We're going to talk about that. And now I think is a timely scenario for our session, because we're going to be bumping up on some resistance areas in the market that we've mapped out in previous sessions. So we're going to want to make sure to keep an eye on those and see how price reacts around them to get a good feel for how long this rebound may continue. There's not a lot really catalyst wise to keep it going. So until earnings season, and that's going to be a big question mark. So that could be what stops this rebound and turns it back around. But we'll talk about that. And because of all that, we're going to focus on a really, I think, effective way to hedge portfolios. So if you have a portfolio of stocks or you're long the market and you may want to hold on to those, that's of course okay, as long as you're hedged, right? As long as you're using good risk control. So we're going to focus on option ratio backspreads today, which is a great strategy for protecting portfolios. And I'll show you how to set it up and on what security to use it on and all that. So we're going to hit that tonight. And we're here to help alleviate fear in the market. So hopefully we'll accomplish that. And then we'll open it up to share some symbols that you guys want to look at as usual.
Yeah, I think definitely these protection type conversations are probably good to have running around now. I think a lot of people might be having some false confidence about the market, and I think you definitely want to be protected right now, just in case.
Yeah. And so we'll look at the VIX, and obviously the VIX has retreated and closed back below 20. So this can be a good time to set up these types of hedges, especially with option ratio backspreads, which can be very effective. And I'll even show you can actually get a net credit for the spread by putting it on. And even in very severe market crashes, they can do very, very well. We'll look at that in the context of the COVID crash back in earlier 2020. So Without further ado, let's go ahead and take a look at the markets. So let me get the platform up here. So obviously big run up on the S&P, well, all major indices after this double bottom that we looked at in our session last week, and actually over the last couple of weeks. So we had spotted this as this 4,200 level as a significant double bottom zone on the major indices, or in particular here the S&P, but we did see double bottoms on the others as well. This almost really a triple, because we got a little bit of a rebound off the 4,150 to 4,200 zone, and then this major rebound. What kind of shocked me today was that we broke through. So due to overnight futures trading, we actually gapped up. So the close on the S&P yesterday was 45.75, and then we opened above 4,600, which surprised me a little bit. I mean, I knew it was coming, of course, because I was looking at the futures, but I didn't expect us to break through 4,600 with so much conviction, because when we look at the, let me get my drawer up here. When we look at this pattern from back in January, where we double topped, right here, right? Generally, when we see this type of pattern where we, get the sell-off, the rebound into, you find support, rebound into resistance, sell off again. This, of course, was a little bit unusual. Kind of have like a W within a W, or double bottom, and then complete that W pattern. We typically will find strong resistance up in the middle of that W. So the fact that we broke through and closed strongly on the day above 4,600 is quite bullish. So let's look at some areas of resistance, because now that 4,600 level is support. It may not be strong though, because if this is a false breakout and sometime in the next 3 days before the trading weekends, we close back below 4,600, then I'll consider that a false breakout. But if that 4,600 level holds, then we really want to be watching higher levels of resistance. And the very closest is at 4,650. So be watching tomorrow and through the rest of the week to see if we can break 4,650. If so, that's going to be interesting to see what happens as we hit, go into earnings season, because 4,650 is strong, 4,600 stronger. But that's our nearest level of resistance right now. So we're today's range is basically very tight, and it's surrounded by a support and resistance level between 4,600 and 4,650. Of course, we didn't get up to 4,650 today. So if we can break 4,650 tomorrow with conviction, then we're going to be looking at 4,700 is our next level of resistance, and then more specifically 4,750. That's, to me, actually more holds more weight than the 4,700 level, because that's where we have this sort of head and shoulders pattern here, where you got the left shoulder, the right shoulder. Here's the head. So if we get up to 4,750, we're gonna encounter some probably quite strong resistance there. And then, of course, unlikely to happen, very unlikely to happen through the remainder of this week before our session next week. But 4,800 is obviously our area of highest resistance at the moment. So those are some big ones to watch. They're all pretty tight. And then the other thing too is whether you trade options or not, now's a good time always, while you're mapping these levels out, to be watching probabilities on the options chain. So we've covered this in past sessions, so I won't get too deep into it. But as we're looking at these levels in a certain context of time, whether it's through the end of this week or through the end of April or whatever, we want to be watching the options probabilities. So we've of course only got, I think, what is Thursday's the 31st. So we've only got 2 more trading days after this to complete the month of March, or we can go out to April 1st, Friday's expiration. Because generally, when we're mapping these levels out, some of them are going to be shorter term, where we're much more likely to touch those over the next day or two. Like for instance, 4650. Whereas 47, 4750, very unlikely through the end of this week. So when we select an expiration to gauge option probabilities, we don't want to select this Friday's options expiration to determine probability touching the 4,800 level, for instance, right? Because we can look at that, but it's let's see. So on the call side, so on 4,800, we have only a 1.67% chance of hitting that by Friday, which is what I would expect. But what's more in play? Well, 4,700 is in play this week. So if we look at 4,700, right, we see we have actually a 25% chance of touching that level by Friday. So not real high, but it's 1 in 4 chance. So it's not out of the realm of possibilities. These are constantly changing as trading progresses. So this is something to keep an eye on as the trading week goes on. But as of the close today, we've got a 25% chance of hitting this 4,700 level. I think I would probably, ignoring the options math, give it a little bit higher chance than that. But again, what's the catalyst going to be? Right now, it's kind of the catalyst is more of the hope around Russia and Ukraine opening, lines of communication to hopefully resolve the conflict. But this is all hope. There's not enough there yet to rely on for longer term positions. So short term, we just need to be watching these half century and century marks on the S&P for resistance. But so far, sentiments remain bullish. We're breaking through some pretty strong resistance zones. 4550 was a really strong one because we had a lot of rejection off that level back in August last year. And we broke right through it. It was support towards the end of the year last year. So there was no hesitation around that level, except maybe on a few trading days ago. But the very next day, broke through it with conviction, closed higher on the day, and then same thing happened today. So unless something, some bad news comes through the news wires, I think that we could potentially be hitting some of these higher half century and century marks in the S&P. But again, just realize that there are some significant overhead levels of resistance that we want to be watching for. Okay, and let's take a look at the NASDAQ. Okay, so similar story here. We have our double bottom, same W pattern. We broke through 15,000, so we broke through a strong millennial mark. So again, bullish on tech, and often tech, leads these sell-offs and rebounds. So it's a good barometer. So this high from back at the end of January, so kind of around the 15,200 level, was broken today. So that's our bullish sentiment on the NASDAQ. So right now, depending on what happens tomorrow and through the rest of the week, we have two strong levels of support below us, 15,000, 15,200 on the NASDAQ. So for resistance, we want to watch the 15,500 level. And that's going to be our difficult. We'll take a look at the options probabilities on that too, but that's going to be probably a difficult one to hit, or either hit or break through. And then we've got, 16,000 is really our next real significant level of resistance. All right, so those are the ones I want you guys to watch through the rest of the week and potentially into next week, depending on what happens here. So definitely some room to run here on the NASDAQ. I was long the NASDAQ and S&P E-mini futures through yesterday. I actually closed them out just because I got in lower down on the trade trend signal. And when I saw the resistance here, I wasn't real confident we'd break through. And of course we did. And I wish I would have held on to it, but hindsight's 2020. So anyway, came out with a nice trade. But now that we've broken through, I may look at, taking a really short-term long position on the S&P and NASDAQ E-minis up into this 15,500 level. Of course, this is on the NDX. We're not looking at the NASDAQ futures, but got a little bit of room to run there if it can hold. If these two support levels hold, then I think we have a good chance. So let's look at the options math on that. And you can do this obviously for any expiration. So we're just kind of talking short term through the remainder of the week. So we want to know what are the odds that we're going to hit some of these significant resistance zones that we mapped out. So 15,500. We've actually got a better probabilities on the NASDAQ than we did on the S&P for hitting that next resistance level. So that's almost a 40% chance of hitting that by Friday. 16,000, we're way down. That's highly unlikely. But 40%, again, pure options math, not taking into account the price momentum minimally, but more so the support and resistance that we've mapped in the analysis that we're doing. So, I tend to find if you add that in, throw that into the mix, add it in, and look for the confluence there between support and resistance and options probabilities, you tend to do, the probabilities tend to be a bit higher than what the option statistics actually say. But 40% purely based on math there, hitting that 15,500 level. So again, that's a really important one to watch. And our next major level of resistance on the NASDAQ. And so then when we look at this in the context of the CBOE volatility index, the VIX, which we know is inversely correlated to the S&P, as the S&P runs up, the VIX has made this really strong move back down. And we also called this one on our past Tuesday night sessions, because when we looked at the resistance zone between 35 and 37, we obviously have some major rejection off those levels. That was our clue in combination with the trade trend algorithms and the support and resistance levels, that the double bottom was forming and the sell-off was losing steam, and then the market was turning back around. So we were able to use these three things: the VIX, the support and static horizontal support and resistance, and the trade trend algorithm to spot this in advance, which is gives us a huge advantage, right? So currently we are below 20 on the VIX, so close at 1890, and we actually had two consecutive daily closes below 20. All right, so, and this is where we're going to get into using the VIX as portfolio protection or even speculation to using options, but also using that to time the market. When is the rebound losing steam and potentially reversing, or like we did a few weeks ago, when was the sell-off losing steam and then reversing back to the upside? So when we see the VIX go back down below 20, and it at or around the same time, we see the S&P reaching a resistance zone. That's our indication that be cautious, potentially scale out of, and this is why I got out of my E-mini S&P and NASDAQ positions, my long positions in those two futures contracts yesterday, because we got a VIX close down below 20. We've had a sharp move. And once the VIX gets down below 20 and I'm long, I don't want to, certainly don't want to add any risk to my positions. And generally that's an area I'll look to start taking profits off the table. So that's where we are right now. Not to say, that the VIX can't continue to go down. We're typically over the past year, we're basing around 15. So we could get back down to 15 if we hit those higher resistance levels that we just mapped out. And so since we broke 20, which is a support zone, right there, 20 is a big support / resistance zone because it's kind of the line in the sand. It's pretty close to the all-time VIX average, right around 20. And so you'll see like a lot of price action, rejection, support around 20. And then of course, 15, if we stay below 20, is historically speaking over the last year, like the best spot to hedge, because we get big spikes off the 15 level. But we also could get a big spike off this whole zone. So anywhere in this zone, and even below, if we are, the VIX has certainly traded below 15 in the past, but this is a good zone to look for protection or insurance, or even speculate on a market sell-off. So we're going to look at using ratio spreads here real quick to do that. It's a great strategy, especially for hedging and portfolio protection, because as I mentioned, you can actually do it for a net credit a lot of the time. And if the VIX does spike, because we're going to be looking at doing a ratio backspreads on the VIX, they can pay off pretty high without trading a whole lot of contracts. All right, so we'll jump over into that, but I just want to pause, Richard, and see if there are any questions we want to answer before we get into the ratio backspreads.
No questions so far, but are you surprised that it's kind of broken through these resistance areas so quickly as of late, or do you feel more like it's a short-term kind of a punch to kind of fake the market out?
Yeah, I mean, yes and no. I think that I think there's more risk in the market than the move is giving credit to. I think that it's kind of a little bit of irrational exuberance where it's just more momentum based, and because of the extreme of the January sell-off and then the double bottom, enough buying came in to the market to push it higher, and then of course that creates momentum that can often cause it to go somewhat parabolic, like we've seen before it everybody realizes, oh, what's actually pushing this up? Hold on a second, and then it just takes very little to reverse it back down. So that you constantly want to be looking at, like, what are the catalysts on the supply and demand side that could cause a trend to continue in either direction. And I think there's just not a whole lot left now. If anything, it's really going to take like strong QE, like quarterly earnings, or like a quick unexpected resolution to the Russian-Ukraine conflict. It's going to take something like that to keep this thing going up into previous all-time highs. So,
gotcha. So basically, like a borderline miracle.
Yeah, I mean, you never know. Yeah,
Things could happen, you know.
yeah. It's just, I mean, it's still, regardless of what happens, it's all supply and demand. If enough people want to, big funds want to come in and buy up shares, and but the key is just always remember, like when we see a big move off of a strong support level, like we did, um, on the major indices, like down here at 4,200. That's just because so much money came in at this level. It's not, you don't want to be fooled to think that there's still tons of buying going on up here, because it may not be. And actually, last week we looked at, that was the topic of our session last week. We looked at, one of our good members had requested that we look at how to use, well, first, I guess, to spot institutional buying, outside of looking at, filings from hedge funds and things. It's difficult, but we can look at, use certain types of volume. And last week we looked at on balance volume, and volume profile, or volume at price, to help us identify that. So that can also be used. If you didn't attend last week, you can watch the recording of that. But we went over how to look at volume, specifically on balance volume and volume profile, to see where a lot of this buying is coming in. And then when you see it start to dry up, and certainly as you see that happen near a resistance level, that's where a lot of people get trapped, because they're not taking that into consideration. They think because there's a strong move up that the buying is still continuing. Well, the buying could have ended, days ago or even weeks ago. We don't, that's somewhat difficult to tell, but using those volume tools, we can get a good idea. And especially when we use them with support and resistance, rather than get trapped into that, exuberance or euphoria, then you can actually be prepared for the market to hit a resistance level and reverse back. And again, also doing that using the VIX. But I realize too, some people don't want to unwind a position, or maybe they're longer term buy and hold investors. And this is going to be a good topic for you. And even a short term trader, I mean, like if I'm doing a swing trade, let's say an index ETF like the SPY or the QQQs, or and I just don't want to dump the position. Well, this is going to be a good way to protect on a markets, a short-term extreme market sell-off and a spike in the VIX, is the ratio spread. So I can jump into that if there aren't any other immediate questions. Oh, actually, I wanted to point one other thing out too, before we look at the VIX ratio spread. And I think maybe we've touched on this a little bit in the past, but another tool to use is the VVIX, the CBO VIX Volatility Index. So ticker's VVIX. This actually gives a little bit of kind of advanced notification of the move in the VIX. So it's the volatility index that tracks the volatility in the VIX, which is of course a volatility gauge. So but it can be a handy, a tool to see maybe with a little bit of advanced notice what the VIX may be doing. So also we could be looking at the VVIX and without redoing it all, we map out support and resistance on this. Obviously, we're at a strong support level on the VVIX. So that might be our, because the VIX itself just broke through strong support at 20. But the VVIX has been basing around this major support level. I'll just draw out that one. That's kind of right around like 104, 105 zone. And you see how significantly the VVIX has moved off that level. That's also a bit of a warning. Take heed that we're potentially approaching resistance on the S&P and the other major indices. And that might give us a little bit, maybe a day or two of advanced notification as it relates to what the VIX itself is doing. So VVIX, but we're going to look at doing the ratio backspread on the VIX. And you don't need to be real precise with the timing. Let me look at the VIX chart again here. But right now there's no trade trend signal, but when there is a trade trend buy below the 20 level on the VIX, like we've seen many times in the past, as it relates to timing, these can be good times to hedge with VIX options, and specifically, like we're going to look at the ratio back spread. So we don't have one right now, but the point I was about to make was you can use this zone. So like below 20, but right now we're looking at a base of 15. That zone, anytime the VIX enters that zone, and you either want to speculate on a market drop and a VIX spike, or you want to, you have long positions that you don't want to get out of and you want to protect. This is the zone where it tends to make sense to set this type of strategy up. So I'll show you how to do that if you guys haven't traded the ratio back spread. But any other questions there, Richard?
No, we're good.
Okay. All right. So there's a lot of like opinion out there in terms of how far to go out in expiration. Sometimes you'll see like people saying go out 3 or 4 months. Others might suggest going out only 30 days. I think if you do your homework and you really look at the support and resistance levels, monitor the VIX every day, use the VVIX to gauge potential future price action in the VIX and the markets. In my opinion, I don't need to go out 3 months. I know that when the VIX is down at that level, there's a much higher probability of a spike as it relates to everything we've talked about. So what a ratio spread, back spread does is, well, first it basically involves, so we'll look at like going out 30 days for our example, selling one at the money call contract and then buying 2 out of the money call contracts. So it uses the short at the money call to basically finance the cost of the 2 further out of the money calls. So it has a limited downside risk with virtually unlimited upside. So when you get a huge spike in the VIX, it can pay off like a lottery ticket. So because I can't do this in the simulated platform on TOS, I can tell you that like if you had just sold back in February of 2020, when the market was hitting all-time highs and bumping up against resistance and the VIX was very low, if you had just sold 10 at the money VIX contracts and then bought, at the time, I think it was like 15, the strike was 15. So like if you had sold, I can't remember exactly, 14 or 15, let's just say, 14. If you had sold 10 of those 14 strike contracts and then bought, because remember it's a 1-to-2 ratio, 20 of the 20 strike contracts, a month later, as the market was crashing, and I think that was actually going out like 2 to 3 months in expiration, it paid off a little over $50,000 on just a 10 to 20 contract ratio. So not a huge, contract size or position size, but a big payoff. Of course, it was a huge spike in the VIX, but they can still pay off really nicely on even a spike up into the 30 to 40 level. And they can also pay off if you don't get the spike because you're actually collecting a net credit. So there's a profit zone on those that can work out nicely. So basically, I'm kind of limited what I can do here in the platform, but I'll show you what you want to be looking for. And then, why we do it and how to, select your position size. That's going to be a bit difficult because it depends on, what kind of hedge you're trying to create for your portfolio, if you're just using it for speculation. So I always urge our members, if you are trading options or you have a platform, your broker platform that allows you, and any options broker platform will allow you to do this, to analyze the payoff or the risk profile. Once you set up, you can add a simulated trade and toss and set that up and analyze that to see where the profit zones are and what the potential payoff is if the VIX spikes to, let's say 30 or let's say 35, because we know that 30 to 35 zone is a major resistance zone for the VIX. So maybe we expect when the VIX gets below 20 that there's a high likelihood it'll spike back up into that zone. So we can actually see what our potential payoffs are. But we don't want to get ahead of ourselves here. So what we want to look for right now, the VIX closed at 1890. So if we were to set one up today, for instance, we'd be looking at the closest to the at the money strike, and that would be the 19 strike. Okay. And you can see that the midpoint, oh, that can't be right. Just use the numbers here. Is, let's see, 30, 90, 45. So it's a little over $4, or 460 a con, or sorry, 420 a contract, 415, 420 a contract. Then we want to look for a strike where we could buy. So let's just, for simplicity's sake, we're just going to buy one contract, right? Or sorry, sell. We're selling at the money strike, and then we're going to buy at a strike that's where the premium is about half of the premium, half or less, depending on where the VIX is, of the premium that we sold, right? So 19 strike, our premiums, about roughly 410. The bid asks are way off because the market's closed, so the midpoint is not 730 on those. And then, so let's say 410. So we want to look for like $2 or less. So then we're looking at like the 24 strike. But I like to go a little bit lower because when we get a VIX spike, I mean, it's not, it doesn't take much of a move down in the S&P to really spike the VIX. In January, we did get a big move down, but we were down at 16 on the VIX and we spiked up into 39. And then on the follow-up sell-off, we were basing around 20, and then we spiked up into about 38. So these spikes can happen quickly, and it doesn't necessarily take a whole lot. But even if we don't get up into that 35 to 40 zone again, even some of these mini spikes can potentially work out fairly nicely. So you can see and that's why we want to be watching these resistance levels. You can see there's strong resistance at 25. So if we look at the 25 strike, it looks like we can buy those at a 2-to-1 ratio to the 19 strike that we would be selling at, and create a net credit on the trade. Basically, to set that up is you'd be setting up a back ratio spread, is how it's listed in TOS. I just need to switch this because we're actually selling. I said we're going to do 1 to 2. Let's just do 10 to 20 contracts for the example. And then that was the 25 strike. Because the bid asks are all wonky, it's not going to show the right, but that should be a credit on this setup. So by selling 10 of the 19 strike calls, the April 27th expiration, and then buying 20, so again 2-to-1 ratio, the 25 strike calls, you would should be getting a credit for this. So, and you want to set this up while the market's open, so you have accurate bid ask spreads and everything. Because the 25 we're looking at, so the bid's at 150, ask is at 229, so that's about 80 points, 40. So it should get, be closer around $1.90 at the midpoint. And again, that's less than half of the cost of or the premium at the 19 strike. So by selling one of these, it'll cover the cost to buy the 2-to-1 ratio at the 25 strike. So your long 25s, short 19s for a net credit. That's the idea. Again, you want to look at that and obviously not trade advice here. Not even something I'm setting up personally. I'm just showing you the structure of it and how to do it. And then you should get a net credit for that. And I don't think in here, let me see if they'll let me do it on the demo platform. Okay, so if they do, it's probably not going to. Yeah, it's going to be wonky because we can't rely on this because the midpoints are off due to probably partly the simulated platform, but also the market being closed. So you'd want to, but you can go in and analyze, if the VIX were to go up on this setup, what would the profit potential be? So if we did get like another VIX spike, if we were to set this up, we're giving ourselves, through April 27th, so about 30 days for the VIX to spike. And if it did spike like back up into the 18 or 19 level, you can see the profit potential on this. So it of course depends on when within the expiration cycle that occurs. But if it happens quickly, and we get back up into the 37 level, the profit on that would be over $13,000. And if we hold it through expiration, over 5,500. These aren't meant to be held through expiration necessarily. If you get that VIX spike and it goes up into a resistance zone, so let's say the VIX spikes up again, up into this, let's say 30 to 30 or 35 level where we have strong resistance, or there's also strong resistance 28 to 29 zone. Use that analysis, those resistance zones, for profit taking on the ratio back spread. And if the resistance level breaks and it becomes support, and then we're looking at higher resistance like it did back in 2020, you can open up another ratio back spread. You can take profits on the initial one and open another. So there's flexibility in terms of adjusting. You can also scale out of these. You just want to make sure you keep the 1 to 2 ratio. So like if, for instance, you started with our example here, selling 10 and buying 20, you could scale out if the VIX, let's say, hits 30 or 37 or whatever your resistance zone is that you're monitoring. You could buy back 5 of the 19 strikes and then sell back 10 of the 25 strikes. And then you got a short 5 contracts, long 10, but you still got your 1 to 2 ratio to keep that ratio spread. So there's different ways you can manage it. But you can see they have some good profit potential. Again, this is not real accurate because for number one, we would be getting a net credit for this, but the bid ask on the 19 strike contracts is all wonky. And because of that, because it's showing it as a debit instead of a credit, it's showing that if the VIX keeps going down, we would lose the premium, but it's because it was a credit, would retain that premium if the VIX continues to go down. So there's just a little small zone of loss potential in this ratio back spread. And again, I would urge you, if you're consider trading the ratio back spread or want to start practicing with it, make sure you monitor all that while the market's open and the VIX is actively trading, and set these up and do your analysis on your options platform. But definitely a viable strategy for hedging portfolios. A lot of hedge funds, by the way, use ratio back spreads to hedge big portfolios. Ratio back spreads on the VIX, or can even be used as a speculative trade as well. So any questions on the ratio back spread? And of course, this can be done on anything, any security that's optionable. But in terms of using it for, in terms of like market sell-off protection, market crashes, anytime there's a lot of fragility in the market or geopolitical risk like a war or a pandemic, these are a great tool to protect against unforeseen market sell-offs. So any
Yeah,
questions?
yeah, I got a couple questions. Ed wants to know how do you determine the max loss on on one of these spreads?
So it depends if you set up for a debit or credit. If it's a debit spread, your max loss is always the debit that you pay for the spread. But the way that I'm showing you to do this, most of the time it's going to be, it could potentially be for a small debit. But most of the time, you're going to set it up for a credit, because generally we're setting these up initially when the VIX is low. So we want we want to be buying our long strikes at a higher VIX, right? So that's going to be a further out of the money strike, and those are going to be, the premium is going to be cheaper. So generally, when the VIX is relatively low and you're selling at a 1-to-2 ratio, so in this case, 10 contracts at the money and then 20 further out of the money, you should probably get a net credit. To determine your max loss, I would use because I can't really demonstrate it here. I would use your probability analysis, because it's going to be based on, when you set it up, implied volatility, what kind of credit you get, and so on and so forth. So always use the probability graph and risk profile, I guess you should call it. So it shows you your max risk on the trade. But another way is when you do your set your order up, some of the broker platforms show the max risk on those. So like if we did a 19 short and then 25 long at 2-to-1, again, this is not going to be accurate because the bid ask is wonky, so it's shown as a debit. But it'll show you, max loss potential based on the number of contracts you're trading, the max profit. Again, the ratio backspread, max profit's infinite. Which is why they're appealing, because the VIX on sudden and severe market sell-offs can spike very high. So these, in past sessions, we've looked at all the major VIX spikes that we've seen since early 2020. And there's been a lot of them. So imagine if you just set one of these up every month with 30 days to expiration, you're going to hit a lot of these on a monthly basis. So yeah, it's going to show you in here. Let me see if try something here. Okay, yeah. So I don't know that that's the right number, but I just kind of guesstimated. If we were to get like an 80-cent credit on this ratio back spread, so it's an $800 credit on shorting the 19 strike, 10 contracts at the 19 strike, and going long 20 at the 25 strike. Again, just for example purposes, the max loss on that would be 5,200 on that type of trade. So, and that's what's appealing, I think, about the ratio back spread is the profit potential on the really good trades is magnitudes higher. So when we do get those really big VIX spikes, they don't happen all the time, but when it happens, one winning trade can wipe out any losers. And again, this is max loss if you held through to expiration, everything else, just like any other trade, should be managed appropriately, adjusted appropriately based on what's happening in the market and in the VIX. And that's why we always start our sessions out mapping out our levels and seeing what's going on. But just based on, hypothetically, if we got an 80-cent credit or $800 based on our position size, that would be kind of give you a ballpark of what the max loss would be on a spread like this at a 10 to 20 ratio. Or 1-to-2, but 10 contracts to 20. Yeah, just to emphasize, always check the order confirmation dialog. And then before I even, as far as my steps to setting any trade up, always, especially an options trade, always analyze the risk profile then I enter it into the order dialog box and check it and make sure. But this is a more valuable tool because it's going to show you the order dialog box doesn't give you as much detail, right? It doesn't show you the risk at certain price levels or expirations, or even what might happen within an expiration cycle. So that can all be done within the risk profile. And again, pretty much any options broker should have graphing for risk profiles of any option strategy that you set up in the platform.
Hey, Brian was wondering if you, since spikes are sometimes so quickly and so rapid, could you ever set up like a contingency order on this?
You can't. I don't. But you're right. And that's a good point Brian brought up, because that's probably the number one challenge with this is timing is of the essence, right? So these can be sudden and unexpected, but that's why it's so crucial to do your homework beforehand. Where is the VIX trading relative to support? And we looked at that tonight as we started. And then where's the S&P moving as it relates to resistance? To me, those are the best ways to time. And then also, as I mentioned, using the VVIX. So VVIX, CBOE VIX Volatility Index, can sometimes give us a little bit of advanced clue about a VIX spike. And this is why I'm concerned about one, sometime in the near term, is because we've based now on the VVIX right around this 105. But you see the difference here. So let me really emphasize this. So see how it's been consolidating at the support level down here over the past couple of weeks, but the VIX itself has been shooting way down. So obviously it's not gonna keep going straight down. It's gonna at some point find support. So I'm looking at the VVIX as a potential, as it's basing its support, because let me we've mapped that out here. Right, so we've got all this major support. All right, so that's first step, and then what happens at that level? Well, we get really big spikes up off that level. Some happen quickly, some are slower. This was a slow one, but look at the spike up on that one. This one was quicker because that was the January sell-off. So we're back down to that level now, and I'm seeing consolidation, which means the support level is strong. So then I want to let's see, clear those out, go back over to the VIX itself and watch for that to find support, right? So we just broke through 20 or turn around. So you could try to use a contingent order and answer the question. It might be tricky. Reason being, typically these sell-offs will happen when the U.S. markets close, because occurs from overnight futures trading. So a lot of times you'll see gaps, and sometimes they're just more extreme than others. Here's one though, like in the January sell-off. So see on January 14th, the VIX closed down below 20. Right, it closed at 1919, and then overnight futures trading, boom, opened up at 2118. So if you set a contingent order, let's say to do a ratio spread, if the VIX hits 20, the order wouldn't have been filled. You can set it up to greater than or equal to 20, but that's a bit risky if anything major happens and you're not there when the market opens and it really gaps up. Like here was a big gap, you can get screwed on the ratio spread. So see that big gap right there? That was the close. Actually, wait, sorry, that's the open to the close. So like 27 to 8, that's like an 8-point gap in the VIX overnight. So I don't like to, for that reason, don't like to use contingent orders on ratio spreads on the VIX or any trade on the VIX really. What I'd rather do is just, and that's kind of the beauty of the strategy. We don't have to time it perfectly. We just want the VIX to be in this, this low volatility zone as the S&P's hitting a resistance level. That's our way to time it. If you do that, you're going to be ahead of 99% of the other market participants, as far as retail traders, not institutions. But that's what institutions are doing. Looking at this zone, and we're now down in there. So we don't have to time it perfectly. All we need is a decent spike up in the VIX out of this zone sometime in the next, whatever you set for your expiration, 30 days, 60 days, 90 days. And that's why some people advocate using a longer dated expiration. Number one, you probably get a better credit, and it also gives the trade more time. I mean, the odds that we're going to spike up out like pretty high over the next 90 days in the market, the next 3 months, is pretty dang good. So it's if you set it out 90 days in expiration, it's a pretty high probability trade. And again, you can look at all the stats for that, right? So like if we wanted to go out, let's just say we'll go out to July 20th expiration, that's 112 days. We can look at, the probability. Oh, these are way all wonky. Yeah, we don't want to use those. They're not accurate because we're in simulated and VIX market's closed. But you can look at the probabilities on the VIX too of it hitting that level, and you're going to find they're going to be pretty high, or they should be pretty high. So again, I'll use those in conjunction. Probability of touching. By the way, if you don't know how to get that on TOS, you can go to customize here. So you just click the layout drop down, and you can add all these things to your options chain. But down in here, you've got probability in the money, probability out of the money, and probability of touching. So that's usually what I look at on the VIX, is what's the probability of the VIX touching a certain level over a certain amount of time.
Okay, there's quite a few questions in here. I'm trying to see if I can get through them.
Okay.
Brian is actually saying like contingent order to exit the trade. Is that okay, or is it you don't want to mess with them either way?
You can, but again, the risk with the VIX is overnight gapping. It's just especially exiting. I mean, VIX spikes reverse very quickly, generally. So see how if it misses your target level or gaps down the next morning, but you see how quickly these can reverse. So it's I would use them as day orders, but not like a good till cancel, because overnight, something could happen or the volatility can drop pretty fast. You just kind of go back and look at these. I probably would use I use a contingent day order to take profits at a certain level. And again, that's all going to be done using that probability, the risk profile analysis. So like if I look at a certain resistance level on the VIX, let's say 25, and if the VIX hits that level, I want to get out. I just want to look and see what my payout would be at that level, and if it meets my risk reward, threshold or tolerance, then I could set up an order to get out of that contingent. But again, just be aware that this takes a little bit more close monitoring, because the VIX makes such big moves, not just intraday, but it can also do so overnight and gap either up or down, and not fill you at a good price on your contingent order. So just something to be careful of.
Gotcha. And William's asking, has a two-part question. Can the ratio be 1 to 3 instead of 1 to 2? And secondly, can you use this on the VXX?
So there's different types of ratio spreads. I prefer to use a 1 to 2, but that's kind of the fun thing about options. You can play around with it. You can look at the risk profile and payoff probabilities and analysis, projections based at on certain levels of the VIX. But I prefer the 1 and 2 because I can, if you were to go 1 to 3, it's going to be much more difficult to get a net credit on that. And so it kind of depends on whether you're willing to, pay a debit for the trade, or you rather have a credit, what your expectation of the VIX is. So, I would never say yes or no to that. I would just say it really depends. But for me, I like the 1 to 2 ratio spread.
And VG's asking, are spikes in BVIX highly correlated to spikes in the VIX?
Oh, wait, actually, sorry. I think I didn't answer part of the last question. What was it the VXX somebody was asking about?
It was, let me find it. It was I think it was the VVIX. Say. No, he said the VXX for the strategy.
Yeah, that's what I thought. So no, I prefer to use the VIX. I don't want to do a ratio spread on the VXX because number one, it's an ETN. It's not. It doesn't do the same thing as the VIX, and you can see that when you look at a longer term chart of it. Right, so it doesn't behave the same way as the actual VIX does, because it's an ETN, and it's not the same type of instrument that in terms of how it gauges volatility. So VIX, in my opinion, is a much better hedge because this has a long-term downward sloping bias.
Gotcha. VG was just asking if there was a high correlation between VVIX spikes and regular VIX spikes.
Oh, of the VVIX, yeah. Yeah, so that's a good question, because that was the kind of point I was trying to emphasize, is this can give you a little bit of a lead on the VIX. Let me see if I can just pick out, let's look at January 24th. Okay, so the VVIX hit major resistance around 170 and reversed and closed down. Let's see what happened on actual VIX. Okay, now see on the zoom in here on the VIX. See the difference in the price action? We still got the spike, but we got to close higher. And then the next day, the VIX actually went up, spiked up way high again and closed down before it finally reversed over. Not so on the VVIX. It immediately went down. So that was, in this case, right here. And then what happened right after that was actually, and the way that it moved down off of that resistance level strongly, was actually a predictor of what the VIX did, which, and so it gave, let's look at this one more time, but it gave a couple days to see how the VIX, so this could have trapped people too. So we get this major, spike, still closed higher, and then gapped up the next morning, but closed down, and then went back up again, and then back down. So this can trick a lot of people. So that's why I like to use the VVIX. Look at what that's doing. It's going to give us a little bit more, a day or two of advanced notice, because then in this case, it actually gave us a good 3 to 4 days before the VIX really went back down. But the VVIX did it first, because it told us that the VVIX is the volatility index for the VIX. So it told us that the VIX was projecting the VIX would go back down. It just took the VIX, 4 days of consolidation before it actually really dropped back down.
Gotcha. James has an interesting question. Can you use an option ratio backspread technique on inverse ETFs for the indexes?
Option ratio back spread on inverse ETFs. My brain's too tired for that. I've never done it. Okay, let me see here. Option ratio back spread on inverse. Like, let's look at the SPX S. Okay. And then if we look at the options, I don't see why not. I've never done that. Let me see what the yeah, I don't see why not. I mean, I've never done it, so I'm hesitant, you know, say, let's see here. So those were at 17s, were at $1.12. So we want to go to like, let's go down to the 22s. All right, so it's showing at the mid a 32 credit. Okay, let's now look at this in, oh, I've got to set it up. Where did I say 22? Well, that's bizarre. Oh, it's just because I need to zoom out of here more. Yeah, so our profit comes in. Okay, there. I'm gonna say that doesn't look like a ratio back spread chart, but it is. Yeah, it should work the same way, looking at the risk profile. But the reason I don't like the idea of it is a lot of inverse ETFs are subject to beta slippage. So like if you like look at the SPXS, or a lot of leveraged ETFs are subject to beta slippage. And so a lot of these, like the XPSS is a triple X leveraged inverse ETF, or like the SQQQ is the leveraged QQQ ETF. And they generally have a long-term downward sloping bias. So yeah, you get spikes in them sometimes, but because of the beta slippage, I don't really like them. So if I guess my word of caution would be if I were to set one of these up on an inverse ETF, it would be with a very short-term expiration outlook and expiration. I wouldn't set one up like on the VIX. It does make sense if that's your preference to go out 90 days in expiration to give yourself 3 months to hit that VIX spike that you're expecting. But on an inverse ETF, I don't like it. Inverse ETFs, number one, you have to be worried about beta slippage with leverage ETFs, and then they have a long-term sloping bias. That's why I like doing it on the downward sloping bias. That's why I like doing these on the VIX so much. We know that the VIX is always going to spike at some point, and it's always going to come back down. It's an inevitability. What's really inevitable with like an inverse ETF, like let's say the SQQQ, is the more inevitable there is it's going to go down to zero. In fact, there's a lot of controversy around these. They're not meant to be buy and hold anyway, but they're meant to be intraday traded instruments. Some of these big like triple leveraged ETFs like SQQQ or SPXS, SPXL. So I guess it would depend also on the type of inverse ETF, what market it's tracking inversely and all that. But yeah, I like to keep things simple. I'd prefer just to do it on the VIX.
All right, that's all I got on that.
All right. Well, we did run over. I apologize. We can take about 5 minutes or so to look at any symbols that you guys want to take a look at.
I got one. Moshi put this in last time, and we didn't get a chance to do it. He put it right in the beginning, so make sure we hit that. He wants to look at the daily on the Aussie yen. AUDJPY.
Okay, yeah. Um, yeah, so this is kind of like is it like a safe haven currency that the yen, like a lot of times in uncertain times, a lot of money goes in. Um, so obviously there's been a huge parabolic spike in the Aussie yen. This is actually interesting. But you'll see the Aussie yen spike often when we're in conditions like we are now with a war or something that's major geopolitical. And yeah, there were some really nice signals down here, buy signals back in January. So this would have been a great time to enter, but it's moved up. Let's see. Was there a specific question around it, or just kind of wanted more analysis on?
You just noticed it was that big spike. Is it just looks like it's been trading kind of funky lately?
Yeah. So there was the last long signal on March 17th from trade trend and then triggered 18th is still open. The trailing stops down here, and then there's actually a sell signal up here yesterday. Entry is going to be 91.31, so right at the level of the trailing stop. That could be a potential reversal, but because of everything that's going on right now, it's a tough one to call. I would kind of tend to stay out of this one. I think the short signal could be an entry for a little bit of a correction to the uptrend, but certainly counter trend. If I were to see this one pull back, and I don't trade the Aussie yen, but just hypothetically speaking, if I were to see it like pull back to maybe a 50% fib level or a major support, if the Russian conflict is still going, would maybe look at a lower priced entry on a buy signal off a support or something. But it has moved up a lot, and certainly were some really nice signals here along the way to the long side. So,
all right. How about can you look at AMC for VG?
Going back to the movie theaters. All right.
I saw that new trailer for the new Top Gun movie come out today. I want to see that.
Oh yeah, that looks cool. I have a friend that's a major like aviation enthusiast, but also major Top Gun enthusiast, and he named his second son Maverick.
Really? That's hilarious.
Like, oh, yeah, that's at least
this is better than Goose.
Yeah, I was gonna say better than Goose or Iceman. So, yeah, AMC had a really great buy opportunity here back on March 17th off this support level. So there's still an open buy on AMC. So it triggered next day on the 18th. Trailing stop is way down here, but based on what I'm seeing here with this price action, this is pretty extreme. Risk of reversal is high. If I were in a long position on AMC, which I'm not, I would at this point I probably would be scaling out. So there's obviously indecision, but also rejection in this. Zoom out a little bit. So 35. So really the zone is 20 to 35. So yeah, this one's a high risk to me of reversal just because I see that such strong resistance off 35, and it obviously rejected it today. And after a strong move up from, because where was the entry on this one was $15.88. So that's like a double there, more than a double on the high today, but on the close, pretty close to a double off this buy signal. So yeah, I would say that's just based on, there is strong support down here, but I think a pullback to support would be in the cards. Other thing though, this was, I don't know what the catalyst behind this was. This seemed to be more earnings related from back in May of last year. But interestingly, when it did, so there was a rejection here on this previous touch of the 35 level after that quarterly earnings, and then a gap up. So to me, we never want to assume that history is going to repeat itself exactly, but if I were to see 35 break on this to the upside and then have it hold, it might be an opportunity to enter long, especially if another trade trend buy comes in. But that 35 is the one to keep an eye out for. And then of course resistance here up around 45. Yeah, interesting one. I don't track AMC much or watch the stock really at all. So kind of fun to look at. Looks like it makes some pretty big moves, but this might be is this a meme stock? I don't know. It kind of looks like it's behaving like a meme stock back here.
I don't know. I feel like maybe it was. Like, I think there was something last year.
Yeah.
I don't remember.
Negative earnings.
You said yes, it is.
Oh, okay. There you go.
There you go. I don't know if we have time for any more signals, but William was wondering, do you ever trade volatility on oil?
Do I trade oil?
Like volatility on oil.
Volatility on oil. I'm not sure what he means.
Yeah, everyone's saying it is a meme stock.
Okay, that's funny. I didn't know that, but I could spot like just based on how it's behaving. Well, plus it's AMC. I mean, it's like GameStop. What's the?
He's saying OVV is oil volatility.
Oh, OVV.
Yeah.
Ovent. I'm showing Oventive Inc. Is he talking about futures? Well, that can't be right. Yeah, I guess I'm not. Does he have the ticker? Oh, you said it's OVV is the ticker?
Yeah, it's in the Q&A if you pull it up. Let's see.
Yeah, I don't know. I haven't heard that. And when I type in OVV, I'm getting Oventive Inc.
Okay.
Well, Steven said that's the old Encana stock. Maybe not.
He's asking if you yourself trade it. So
I don't. No, I trade oil futures, so CL. From time to time, not a lot. But I'm not familiar with that one, William. Sorry. You said maybe not right ticker. Yeah, William, if you're on next week, maybe take a look and see. I would be curious to see what you're referring to. Yeah, if you're back next week, let me know. Remind me. I'd like to take a look at that if you find it. Oh, OVX. Got it.
I guess the last one Eric's asked a couple times. If you could just take a quick look at Google.
Okay, sure. OVX. Okay, yeah. Now I know what you're talking about. No, I haven't. Is this like the VIX? Like, you can't trade shares. It's just options, or? It has no options, but it doesn't have a bid-ask spread either. It just could be the demo platform. I'll take a look at it. I have not traded it. Looks like it is quite rangy, but interesting. OVX. It's an ETF. All right. Yeah, I'll take a look, William, and see. I'll look at it in the context of like CL, like the crude oil futures, and see if I notice anything significant, and then we can revisit it next week. Okay. Alrighty. Thanks, everybody. Sorry we went over, but hopefully you guys got a lot out of the session tonight, focusing on ratio backspreads. Always test with paper trading. That's what I advocate. And check your risk profiles and probabilities and all that stuff. And then if there are any final questions, Richard?
Now we're all set.
All right. Well, I hope you guys have a great rest of the week. Thanks again. We'll have the recordings up in the next day or so. And then if you have any questions in the meantime, just shoot us an email, support@altostrading.com. Thanks, Ed. Thanks, guys. Thanks, Keith, Eric. We'll see you guys next week.